Hello, welcome to part two of the chapter one video series, Desk Lectures. At the end of the last video, I introduced what essentially are the three accounting elements: assets, liabilities, and equity. And what we're going to do at the beginning part of this video is we're going to walk through examples of these different items, just so you can start to see examples. So if you're thinking about ways to study for this first part, this first chapter, the most important thing that you can do in this chapter, other than the very last slide, which I'll show you at the end of the last video, is start to get these terms down. Now, most of these are terms that you're familiar with or you've heard of. Like obviously cash is an asset you've heard of. If I asked you what's an asset or give me an example of an asset, 99 out of 100 students would tell me cash is number one. And that's true. It's an asset. It's the easiest one for students to think of because it's one that we interact with all the time. And obviously, it's a good example of that definition of assets. Remember, future economic benefit. Nothing provides a crisper, cleaner version of that future economic benefit than cash, because you can spend it on whatever you want as a business. Another example of future economic benefit is equipment. You can think about vehicles, computers. The computer that I'm using right now to record this video is an example of an asset for Columbus State, obviously. Inventory is another asset you've definitely had exposure to, whether you realized it or not. Inventory is something a company buys to resell to someone else. So obviously any retailer, Amazon, Walmart, Target, these are all examples of companies that utilize inventory, that have inventory. And obviously this is an asset. When you're buying something to sell it, you're attempting to sell it for more money. This is an example of future economic benefit. Property and land are kind of interchangeable examples as well of future economic benefit. Now, I put this one last because most students have not had a lot of exposure to accounts receivable, and I want to make sure to spend a little bit of time on this. Again, if I have seen students at the end of the semester still not exactly sure about what accounts receivable is. And so the more time you can spend flashcards, studying, reading the definitions, however you're going to acquire that information about some of these harder terms, such as accounts receivable, the better off you're going to be. Accounts receivable is an asset account created when you sell something and you have not been paid for it yet. Now, I think one of the reasons why students struggle with this concept is because we don't have a lot of opportunities as people in the US to do this. We as individuals, we might use a credit card, but even then it's being paid for. It's just not being paid for by us, it's being paid for by our credit card companies. But with businesses, essentially this happens all the time where a company sells product to another company and just says, pay me later. And the company says, okay. And then they pay them in a week or 2 weeks or 3 weeks. Because these transactions are so common, this type of transaction has its own account, and it's called accounts receivable. Again, it's when a company sells product and has not been paid for it yet. So they're going to get paid. We'll talk what happens when they don't get paid in a later chapter, but we're assuming, at least in this point early in the class, that they're going to get paid the full amount, and that amount goes into an account called accounts receivable. Moving on to liabilities. Now, one thing that we need to make sure that we're keeping straight is that these are future economic sacrifices, things that are happening in the future, not things that are happening either in the past or right this second. These are things that are happening in the future. And so I use the example of salaries payable because most of my students are familiar with these, though they may not realize it. If you ever work for a business and don't get paid the day you work, which again is most Americans work under this kind of scenario, then the company you work for has salaries payable, where the employees have worked for them and they owe them money. They haven't paid them yet. That's salaries payable. Salaries owed to their employees. Another example of a liability is notes payable. This is a loan, essentially. You can use the word notes and loans interchangeably. Accountants use the term note because it's a written note that shows that it's a loan, but for your purposes, a loan is fine. Loans payable, notes payable, really interchangeable terms. Now you might be looking at this going, wait, didn't we just talk about this? A lot of students have trouble or struggle with keeping straight accounts payable and accounts receivable. And there's good reason for that because they're related to each other. Remember, accounts receivable is when a company sells something to another company and is owed the money. Accounts payable is kind of the opposite of that. Accounts payable is when you've purchased something and haven't been paid for it yet. Again, it's when you've purchased something and haven't been paid for it yet. And so essentially every transaction that occurs in a business environment where money doesn't change hands immediately, one company has an accounts receivable when it's done, and the other company has an accounts payable when it's done. One other thing I'll note, and I should have mentioned this earlier, but I didn't, is you see a similarity between these three terms: payable, payable, payable. That's a nice little tell for you that this is a liability. Anytime you see the word payable, it's a liability. The word payable means to be paid. And so anytime you see payable next to anything, you should automatically know it's a liability. The last example of a liability that I'm going to give you is one that's I'm probably stretching a little bit. This is more of probably a chapter 3 concept, but I do see students at the end of the semester that are still confused about this term. And so I like to introduce it early and often, and that's unearned revenues. Unearned revenues are liability accounts that come from prepayments. I'll say that again. Unearned revenues are liabilities that come from prepayments. So if I'm a business, the example I always give to students is Ohio State football. Season ticket holders to Ohio State pay for their tickets in advance, sometimes months and months in advance for their tickets. And so Ohio State takes in all this money early, and they don't get to record that as revenues because they haven't done anything. The football team hasn't played yet. And so those monies go into a liability account called unearned revenues, and will sit there until Ohio State plays their football games. And every time there's a football game, they record a little bit of revenues. And so if it's right before football season, and you were to go look at Ohio State's accounting books, you would see unearned revenues, and you would see a big number there. And it's a liability because Ohio State owes a service. Other examples of companies that see unearned revenues: anything in the wedding industry, magazine subscriptions, concert venues, things like that. The last element that we're going to talk about is equity. Now, this is one of the reasons why I like to kind of wait and define equity, is because equity is defined as assets minus liabilities, which is to me kind of a little bit of a soft definition. Like, it's just, we're defining the terms with other terms. And it's very important. Equity is very important, and you'll see some examples of it shortly. But one thing I do like to point out to you is that if you've ever talked about equity in your life, your home equity or your equity in your car, you're talking about this exact term. You're talking about the value of your home minus what you owe on your home, or the value of your car minus what you owe on your car. And it's the same term. It's not any different. Some examples of equity you're going to see in this class. The first and the most common one you'll see is revenues. Anytime a company sells something, anytime a company sells a service or inventory, they're going to record revenues. In addition, any money spent to support a business, payroll, rent, anything like that, when the payments for these are made, these are probably expenses that they're paying. And in chapter 3, things will get a little bit more complex, but for now in chapters 1 and 2, expenses are all these ongoing costs that a business incurs. Two other aspects of equity. The first is a dividend, which again is a term you've probably heard of. There's a reason that individuals invest in companies, and that's because they want to make money. Well, if you invest in a corporation, there's really only two ways for you to make money. The first is the stock price to go up, and then you sell the stock later at a higher price. But a more common way that individuals make money off of their stock investments is with dividends. And dividends are just payments to the owners. Literally, dividends are checks cut to the people that own their stock as a return on that investment. And common stock is another example of equity that you're probably familiar with. A share of stock, is just an ownership block in that company. And so if you want to be an owner in a business, you buy some stock in the business. Now I'm hopefully going to tie this up in a nice little pretty bow for us here in the accounting equation. And first thing I'll tell you is this is not anything new. We actually just covered this. The definition of equity. Equity equals assets minus liabilities is in fact the accounting equation. Assets equals liabilities plus equities. They're essentially interchangeable equations. If you know just a little bit of algebra, you can see that these are essentially the same thing. This is a super important concept. It's underneath all the work we do in accounting is this accounting equation. Hopefully by the end, you'll have kind of forgotten about the accounting equation. You'll become so kind of ingrained in what we're doing, and everything will become second nature to you, that the accounting, you won't be thinking about it or referring back to it a lot. Now we're stopping this video shortly, but I do want to give you a little bit of an introduction into what you're going to be doing in Worksheet 1. Worksheet 1 is just a simple list of accounts, and each account has a type: asset, liability, equity. And if it's an equity account, either write revenues or expenses next to it if you need to. And keep in mind, as you work this worksheet, there is an exam question very similar to this that you need to be prepared for. And so do your work on this. Don't just look at the answers and say, okay, I got this. That's not how we're going to learn this. So good luck on your worksheet. Keep in mind, there are maybe a couple of items on the worksheet that you haven't seen before, and that's okay. Those are terms that we're going to see later. That was intentional, just to kind of stretch and give even folks that kind of are paying close attention still a little bit of a challenge on the worksheet as well. Thanks for listening. See you in a minute for part 3. Is this part 2?